everybody, what's up? Thursday, February 25th. Whoa! Big down day, big down day in the market today. So yesterday we're up big, today we're down big. But I want to talk about bond yields surging. Now I know everybody is looking at this and saying, wow, inflation. And yesterday I talked about how the inflation trade, right, which I called a year ago, that actually going back even more than a year, I was talking about under Trump and the fiscal expansion, like way early on in his administration, and the increase in government spending. I was saying that that's a growth phenomenon. It's going to have some inflationary pressure attached to it. And of course, last year with the COVID and the really massive amount of stimulus and more that was added, that just, compounded the inflation impulse. But, now everyone's piling on this trade. I did a video yesterday saying that it is going viral. All right, so I just wanted to state that fact, all right? But let's talk about bond yields, because a lot of people have been, I think, conflating what is happening with bond yields with that inflation outlook. And I don't think that's really what is going on, and I'm going to explain it. Now, there is some of that attached to it, but look, let's understand something. The long-term yield, if you look at the yield curve, and as you go out along the term structure, that reflects Fed policy over the term. In other words, a 2-year yield should reflect Fed policy over a 2-year period. A 5-year yield should reflect Fed policy over a 5-year, etc. 10 years should reflect it over a 10-year. When the Fed says it's going to stay at its current rate, and they're very adamant about that, there shouldn't be that much of a steepening of the yield curve, because essentially the expectation function of investors is that the Fed is going to hold rates steady, and therefore that just gets reflected along the entire term structure as you go out. So you really shouldn't have this phenomenon of just, every day a steepening of the yield curve. So what is going on? What is causing this? Well, you could say, hey, people think there's going to be inflation, so they're selling bonds because, you're going to lose money if there's inflation. I've even seen stories about hyperinflation. I talked about that. That's ridiculous. Like comparisons now, because of the stimulus, we're going to be Weimar, Germany, or freaking Zimbabwe, or that kind of stuff is just, it's just foolishness. It's stupidity, all right? So what's going on? What can explain the steepening every single day of the curve? Well, here's what I think is going on. And this gets back to a subject that I have spoken about many times here, and I'm the only one really who has spoken about it. I mean, now you're starting to see some other people mention it, but I've been the one really talking about it, is what is happening with reserve balances on bank balance sheets, okay? So we know that reserve balances are at a record level, 3.4 trillion, actually just slightly under this week, 3.385 or something like that. But here's the problem, and I've explained this in the past. Banks have to conform to certain regulatory mandates, all right? One of those things being the supplemental leverage ratio. And reserves are bank assets. So the supplemental leverage ratio, very simply, is bank capital divided by consolidated assets in the denominator. When the government, as a result of huge spending, or when the Fed buys assets, that increases reserves on bank balance sheets. So the denominator in that number gets bigger, and that leverage ratio shrinks down below levels that they are required to sustain. All right? And normally then what happens is the Treasury sells securities, right? Sells bonds and notes and bills to drain out some of those reserves. See, I've said it before that the sale of debt instruments is not debt, it's not borrowing, it's a reserve drain. Anyway, what's happening is that because of the, large amount of spending going on tied to the stimulus, and there's going to be more stimulus coming, and for some reason now, Treasury has been reducing the amount of bonds that it is selling, all right? We're starting to see reserve balances really build up on bank balance sheets. So what happens as a consequence of that? Well, they have to keep that leverage ratio. And okay, just as a side note, that leverage ratio was kind of changed last year by the Fed. They said you don't have to include reserves in the calculation, but banks still have internal, levels that they maintain. So they got to cut, because now all these reserves are coming on bank balance sheets, they got to kind of make room for those reserves. Otherwise, their ratio gets all screwed up. So what are they doing? They're selling assets. And among those assets, Treasury bonds. They're selling Treasury bonds. This is why Treasury bonds are going down in price and up in yield. All right. It's why the yield curve is steepening. It is because of this gigantic tsunami of reserves hitting bank balance sheets right now. So they're compensating for that, right? They're making room for that. They have to, by liquidating treasuries. And that's how come you're seeing this happen. And somebody asked me today, well, look, I think there was an article about how the auction today, I don't remember, it was a 2-year auction or something. Why did it go so bad? There was a big post in there by that ridiculous blog Zero Hedge. Oh, it was a terrible failed auction. Well, no kidding. The dealers don't want to bid very aggressively on any size because they got to make room for all these reserves, this tsunami of reserves that are coming on their balance sheets. So this is what's going on. Now, this is kind of, all this stuff is kind of technical in the sense that, it's got to pass through, like the analogy when the python swallows the pig has to pass through, right? I mean, eventually Treasury is going to bring its account balance down to a level where it wants. I think they want it at 500 billion. It's at 1.4 trillion right now. So a lot more reserves are going to be coming. But eventually this whole thing passes through and we get back again to a normal situation. But in the meantime, as you could see, it's destabilizing because it's driving up bond yields and everybody's going like, oh my God, what's going on? There's going to be inflation. There's going to be hyperinflation. I saw a thing today where there's Bill Ackman, the hedge fund guy, he's putting on like this big inflation hedge thing now. I kind of laugh at all this stuff because, they're reacting now to something which is like really technical. It doesn't even have to do with inflation whatsoever. As a matter of fact, if you look at gold, gold's languishing. Like gold is still a good inflation barometer, and it had been going up for the last 4 years, three and a half years. And now since last August, it's kind of nowhere, okay? I mean, if there was real inflation happening, and even the dollar, which I am bearish on the dollar, the decline in the dollar, if we were having real inflation, like really crazy inflation, the dollar would be tanking, man. But it's going down slow, gently. So yeah, there are price pressures, don't get me wrong. You look at copper, you look at oil, you look at some other commodities. A lot of those things have to do with supply disruptions, all right? Like the Texas freeze, that affected oil prices, and it's going to affect oil prices. copper. You know, you have supply chain disruptions and all this kind of stuff. So that's what's going on. I mean, like I said yesterday, the inflation trade has gone viral, totally mainstream. It's probably going to pause right now, which if you're in that trade like me, it's good that it pauses. So it'll give you an opportunity to add on. Anyway, that's the explanation. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye-bye.